Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, I'm Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View. And today we're going to talk more about private credit and how investors should think about private credit in regards to their portfolio and how they should allocate to private credit. With that said, I'm joined with Jen DeSisto, who's Chief Investment Officer of CW Advisors. And she definitely has a unique view of private credit and of alternative investments given her role over at CW Advisors. And so, Jen, thank you for joining us today. And maybe just, to quickly start out, if you could tell me a little bit about your background, and then, I do have some questions for you.
Great. Yeah. Thanks, Greg. I appreciate being asked to be on this podcast. No, I have a variety of experience across different asset classes. I've managed multi-asset portfolios. I've managed equity portfolios, fixed income portfolios. I started my career doing leverage buyouts. So I have a lot of different opinions on different asset classes and how they fit together in a portfolio for both institutions and private wealth clients.
And so with that being said, what is your view and outlook of private credit? We've seen it in the headlines over the last couple of months. It's been sort of villainized. 3 years ago, it was really glamorized, is what I like to say. The media made it sound like private credit had never existed until 3 years ago. And it's something that's been around really since the beginning of time. But more importantly, coming out of the great financial crisis, private credit really grew given the fact that the traditional bank model as we knew it was broken. And it was really filling the void left by traditional banks on the lending side. But what's your outlook and view of private credit?
No, I think I'm excited for private credit. I think we've seen massive growth in the private credit space in the last few years. As you mentioned, it's been around before the great financial crisis, and it really took off after then. But I would say now people are seeing it in the wealth space, so they perceive it differently. But it's been around for a while. And I think what we've seen more recently, we've seen a couple of instances of loans blowing up, but they actually were not tied to the private debt space. They were actually syndicated loans and warehouse lending and things related to banks, not actually in the private debt space. So people see these headlines and JP Morgan coming out and saying there's cockroaches and things like that. And people perceive that there's widespread issues in the private debt markets. Howard Marks at Oaktree just wrote a letter last week about it. And he said defaults are a normal part of making loans. In any given year, you're going to have 2 to 3% default rates in the debt markets. And he's not seeing anything unusual this year versus any other year in the default space. And actually, I've seen charts more recently where the default rate has been coming down a bit. It sort of peaked about a year ago. So I'm actually not too concerned about the private debt space. I think going forward, there's going to be more opportunities and there will be a need for private debt. I think people are worried about interest rates coming down, but I think they're not going to fall off a cliff and we're going to be back to the 0% interest rates. So I think relative to the public fixed income markets, private debt still makes a lot of sense for investors.
Yeah, I share your sentiments. It's funny. I read the same report from Howard Marks, and I agree with him what he was saying in that report because it is normal that you have defaults, and I don't think this is necessarily the canary in the coal mine like people like to say, or when you find one cockroach, there's probably a lot more coming. I don't think that's the situation per se. And private credit does expand so many different asset classes. And so within Peachtree, for instance, we're focused primarily just on private credit within commercial real estate. And that's a subset of what's happening. And a lot of the headlines was around, more of a fraud type situation on the corporate side and so forth. So of private credit. But with that said, should high net worth investors invest in alternatives from your standpoint? And I know private credit's one, bucket of alternatives, but how do y'all view from CW Advisors, how do y'all view investing in alternative investments in general beyond just private credit?
Yeah, no, I think they should. I think it's been interesting because we've really had a big push since I joined about a year ago. And it really depends on the client situation. I have a lot of advisors pushing back on me. They're like, why should we be offering private investments to clients? Do they really need it? And I think they do for a number of reasons, but I also think it depends on the individual's particular situation, their liquidity needs, their tax situation, the size of the portfolio, their risk tolerance, all of those things. But I think, one of the big headwinds has been educating advisors on private investments and how to talk about it with clients, how to think about it as part of the total portfolio and what it can do from a risk adjusted basis and we're seeing the next generation of clients, the younger generations are really interested in private investments. And so we're really doing a lot of education at the firm around private investments and how people can include them in their portfolio. Just the private investment landscape has totally changed over the last 15 years. And I think, we've seen the number of publicly traded stocks cut in half in the last 20 years. So it's just, there's not as many investment opportunities as there once was. The number of private companies out there has grown dramatically. And so we just think there's a lot of opportunities out there in the private investment space for people. And there's just a lot more vehicles to be able to access private investments than there ever have been.
And when you look at different vehicles, because there's no question, because we see it from our side, and obviously we're always sponsoring, new vehicles as well. But, you see some of these vehicles, even on the private credit side, you see it, across even just traditional real estate funds and probably, even across other private equity funds. You see a lot of cases, you'll see, vehicles where they're closed in, there's no liquidity offer, there, maybe a drawdown structure where you're drawing down the capital as it's being invested. And then you see other vehicles where they offer semi-liquidity. I say semi-liquidity. Sometimes I think they almost get marketed as liquid vehicles in the sense that, they're perpetual vehicles or they're evergreen vehicles, and effectively you can technically redeem at any time, but there's always gates that could be thrown up and restrictions. Do you all have a preference on closed vehicles versus ones that have liquid structures, or any thoughts there?
I think, what we've really tried to focus on, especially for the accredited investors who are just getting into this space for the first time, who are really, never experienced private investments, and the experience of having less liquidity. We've been going into the evergreen vehicles. And I think that makes a lot of sense in the private debt space. You have monthly income coming in, loans are maturing, they're being replaced. So I think in the private debt space, that makes a lot of sense in an evergreen structure, but you're not going to be marking the loans every single day, right? So I think that you have private debt into a semi-liquid structure that sort of matches the timeframes generally. So I think that makes a lot of sense for accredited investors. And I think it also makes sense for qualified purchasers, the ultra high net worth clients as well. I think if you're looking at things like private equity and where there's longer duration, the drawdown structure makes a lot more sense in that case. But generally with, the higher turnover or shorter duration of some of these investments in the private debt space, I think the evergreen structure makes a lot of sense. I'm not a big fan of the public BDCs and interval funds, because I worry about that daily marking of books and people overreacting to headlines. We've seen that in the public BDC space, where a lot of those funds have sold off recently because people have been worried about the situation in the public debt space. But I think if people have a longer time horizon and can weather through some less liquid markets, I think the evergreen makes a lot of sense for them.
Yeah. And I can see both sides. Yeah, I think there's probably a contrarian view of just these, semi-liquid vehicles, because ultimately somebody really wants liquidity. The majority of the time it's not there because it's March of 2020, when you hit the pandemic. And everyone's going to throw up gates, March, April of 2020, because the world is effectively falling apart. There was a quick recovery coming out of the pandemic as one example, or the GFC. And when you have these illiquid assets underneath, it can just create, in certain cases, it can create challenges for the portfolio managers to be able to figure out how to best create liquidity if there's huge demand for people to exit those investments. And so I think it puts a lot of pressure on the fund managers, the portfolio managers. We've shied away from having, liquid vehicles just because most of our investments underneath are illiquid. We've looked at, the evergreen structure, and something, we may or may not do in the future. But it's, there's no question there's a place for those structures. I do think I think any investor, when you're investing in alternatives, you really got to have it's not a 12-month view. You really need to have a 3 to 7 year view as you're making these investments, because typically, it takes time for the manager that's investing the capital to execute on their business plan and for the underlying investments to actually have success and so forth. For clients that are just new to alternatives, what's the best entry point from y'all's perspective or framework to begin allocating capital? Is there some framework that you guys try to work through as you're onboarding new clients that are looking to have y'all manage their capital and so forth?
Yeah, I mean, I think I really try to steer clients, especially people who are just getting into getting into private investments, to have vehicles that that have some kind of liquidity or can have distributions to them. That just feels better. It feels like they're getting something back, or they have a shorter duration to them. So, we try to do for accredited investors and some of our smaller QPs is really kind of leg into some of these private investments. And we've tried to build sort of a diversified group of investments that have that semi-liquid type of features to them or have income distributions to them. And we try to steer people more towards their non-taxable accounts, especially with the private debt is generating more ordinary income than capital gains. And so it's just a better approach. And also people tend to just put things in their non-taxable accounts and let them grow rather than worry about needing that for liquidity per se. So, we really try to encourage people, private debt, either, direct lending, asset-backed lending, private real estate debt, the secondary space, some infrastructure type of vehicles. And we really think that kind of gives them a diversified pool of different private investments and different return streams.
What's, from your perspective, when you look at just public, investments in the public sector versus just the, private investments, and when you bucket, because obviously private investments make up everything from private credit, and there's different types of private credit. And then you got infrastructure, as you mentioned, real estate, you got venture funds. What is the percentage do you think a QP should technically, or even an accredited investor, what should be their percentage of their portfolio that's allocated to private investments versus public investments? Or do you have an opinion there?
Yeah, I think, what we're trying to gear some of the accredited investors, again, it's going to take time to build up a portfolio of private investments, but our kind of goal in the near term is, 5 to 10% of your portfolio in private investments if you're an accredited investor. And that feels pretty good. If you have 10% that are, semi-liquid or illiquid, it's not gonna hurt you if there's a market drawdown or if you need liquidity. And like we said, we were trying to leg into it. We think private debt in various flavors makes a lot of sense. It feels good. And I think, for bigger clients, our QP clients, we recommend 30 to 40% in private investments. I think there's a lot of opportunities out there across a bunch of different private investment asset classes that we think are interesting, and it provides diversification across the different asset classes as well. So, I mean, when we look at a QP investor, we're thinking 12 to 15% in private equity, venture, and secondaries, 12 to 15% in private credit, different offerings in that space, and, roughly 5 to 6% in direct real estate and in infrastructure. So that's kind of how we're building around the public markets with the private investments.
So a couple more questions, and we're about to get to the end of time. But, one of the questions is more macro. There's obviously, we've been going through a challenging 2025. There's been some headwinds, obviously. Headwinds create a lot of opportunities. What do you see, or where do you see from your standpoint going into 2026? Are you optimistic, or do you see a lot of tailwinds forming, or are you, a little bit concerned about what's happening from y'all's perspective when you're looking to allocate capital across not only private investments, but also the public market?
Yeah. When we look at kind of the overall view of what's going on out there, I think we're generally pretty positive. There's a lot of headlines, and it's sort of, you have to sort through all of the all of the information and data. Our job is naturally to be somewhat cautious and make sure we're protecting client assets. I look in the public markets and earnings have been very strong, stronger than people expected. A lot of companies have weathered through tariffs. The expectations for next year continue to be fairly strong for earnings. I would say we do worry about the concentration of the Magnificent Seven in the S&P 500. Just the overall valuation of the stock market, gives us concern. But we do think that there are other areas that you can invest in besides the S&P 500. And that going forward, that might be a better place to be. From the private investment space, the last time we saw a real boom in private investments was 2021. I mean, that was a huge year across the board. Private equity was booming, venture was booming, real estate was doing incredible. And then, we faced the shifting of the interest rate picture, with interest rates going from 0 to, close to 5%, a little over 5%. On the treasury yields. And so I think that changed the dynamic. And so we saw a huge fall off in private investments in those areas. And so we're starting to see things gradually come back. I think we're sort of getting through the noise of tariffs. We're starting to see some normalization of interest rates. And I think there's a lot of pro-business policy out there that is helping with M&A. We're starting to see IPO activity. So I think we'll start seeing distributions and sales and things like that will help support the returns in the private market space. So we're pretty excited about that because I think, clients have been sitting there saying, we haven't seen any distributions and nothing's been happening the last couple of years. Why should we put more money into the private equity or private real estate? But I think that picture is starting to shift now. And so I think we're pretty optimistic that things should improve next year.
Yeah, I share your sentiment there too. I think 2026 is going to be a much better year for for distributions back to investors. I think you're going to see a lot more activity in the transaction market, especially as it relates to real estate, and you're probably going to see it in other markets as well. Because I think we're going to have, to your point, a much more favorable business environment. Just with the new tax bill, you'll start seeing the effects of that. Just along with hopefully some easing of interest rates, on the short term side, and the Fed being a little bit more predictable, where people can actually start pricing in. Really have a better understanding of the values of assets. Because I think so much, especially in real estate, it trades based on where, the 10-year treasury rate is going to be long term. And there's still conflicting opinions if the 10 years is going to stay above 4% or drop below it in one way or the other. And everyone has their own opinion. We tend to share the opinion that the 10 years is going to stay above 4%. And so we price assets a certain way. And when there's conviction in where that's going to be, that's going to allow people to actually trade. And I think the Fed will be more predictable, which will allow for hopefully, long-term rates to stabilize one way or the other, wherever it's going to be over the next several years, to allow the transaction market to heat up. One final question. Do you have a favorite alternative investment sector right now that you like to try to allocate capital for your clients into?
Yeah, I think it's sort of like naming your favorite child, right?
Right. You can just say Peachtree too. So you can say whatever Peachtree. No, I'm joking. But you can say private credit, commercial real estate.
Well, it's so funny because I was just sitting with a client yesterday and we were talking about what's really interesting right now. We were talking about, it's fun to talk about individual type of investments. And so we were talking about the project that you guys are working on in Portland, Maine. And I was describing it to the client. And so I think like tangible projects like that get people excited. And so that I think there's a lot more opportunities like that are coming up. Infrastructure is another area that I think there's just a lot of tailwinds there. There's just been huge underinvestment for many years and the need for investment in that space. I think there's a, we could talk about like, a firm that's building out natural gas plant to support data centers. And so individual things like that get clients excited and they're fun to talk about with people.
Yeah, no, that makes sense. And I think those are good ways to diversify, especially portfolios today with so many people so overallocated to the public markets. I think it's always great to be able to, diversify through these individual projects and even through fund structures. And when you look at alternatives, it's all about having access to those opportunities. And clearly, CW Advisors has done a great job being able to onboard different, investment managers that have these alternative investments. And so, anyone listening today, if you have interest trying to allocate capital into private investments, I mean, I'm a big believer. Clearly, Jen, from the comments you made, you're a big believer in diversification, and I'm a big believer diversifying not only across managers that you're investing with that are actually, that are actually executing those investments, but more importantly, in the different, property types or product types, because there's so many different types. As you mentioned, there's infrastructure. I mean, there's, private equity, there's private credit, real estate. So there's so many different ways to invest in private investments. And I think Jen could be a great resource of, if you do have interest, Jen, I'm assuming you're happy to talk to any individual investor, looking to allocate capital into alternative investments.
Absolutely.
Well, perfect. Well, thank you for your time. And I really appreciate you joining us today. And please tune in again for another episode of Peachtree Point of View. So thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.